complicated week for the Indian equity markets this week. Now, Indian equity markets have been volatile over the last few days, with most sectors ending in red. The Nifty 50 index and Sensex 30 fell about 1% each yesterday. The Sensex is now below 61,100, while the Nifty settled below 18,100. The Indian Volatility Index, which measures how much the market will fluctuate over the next few months, increased by about 16% to about 16.05. So what exactly were the factors driving this volatility? In light of an increase in COVID cases in China and the US, concerns about the COVID have returned. So far, India has seen 4 cases of the Omicron BF7 strain, which is causing the current COVID infection outbreak in China. Now, do know that these were past cases and India doesn't have any active record cases of this variant as of now. Now, despite the fact that it hasn't yet truly caused a major panic, the new Omicron variant is known to spread quickly and has a shorter incubation period. Now, the Indian Health Minister has also reviewed the situation with experts and said that COVID is not over yet. Now, this has spooked the markets. Another reason is the surprise change in monetary policy in Japan. Now, this has been the year where all of the main central banks in the world have made a significant shift towards higher interest rates and tighter monetary policy. But the Bank of Japan was the exception up until this week. Now, in a surprise move, the central bank loosened its yield curve control that capped long-term interest rates on 10-year Japanese government bonds at 0.25%. Now, that cap is now 0.5%. This means that the yield on the bond can go up or down by up to 50 basis points from the previous 25 basis points. Do know that the Bank of Japan didn't raise rates and they widened the 10-year Japanese government bond trading band by a mere 25 basis points. But how can such a small move have worldwide implications? Let's understand. The Bank of Japan's decision to raise its interest rates is significant for a number of reasons. Firstly, the Bank of Japan had been the only major central bank in the world to maintain negative interest rates. Now, do know that Japan uses unconventional monetary policy, which includes negative interest rates and capping longer-term bonds to boost inflation. Now, this move suggests that the Bank of Japan may be ready to join the rest of the world in tightening monetary policy. Although the Bank of Japan's action has no immediate effects on the Indian market, it does indicate that the fight against inflation is currently a worldwide problem, even for Japan. Also, the Fed delivered hawkish language at its December FOMC meeting. It downplayed recent progress on inflation and retained a hawkish stance on monetary policy despite another cooler than expected inflation figure in November this year. In a difficult year that had been marred by sharp inflation, rising interest rates, amid a Russia-Ukraine war, the Indian domestic markets have been resilient, with Sensex and Nifty indices reaching 52-week highs and outperforming global peers. Now, the resilience in the stock market, despite several challenges, shows that India indeed has a distinct advantage compared to others. Now, even if the volatility spills over the next year, it is best to stick with good old investment principles. And also know that the Indian growth story is still intact. So what does this particular news mean for you? India is expected to retain its tag as one of the fastest growing economies in the world. The underlying fundamentals and growth prospects of India are strong, and the short-term headwinds will have a minor impact on the country's long-term outlook. This will have a direct neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.